Good morning, everybody, or good afternoon. My name is Jason Allen Jankovsky. My website is netwinningtrader.com. Thank you for coming. I'm very pleased to be broadcasting again with David and his crew. Um, Always have a really good time here, and the clientele, the people that are listening, you guys, a lot more interesting people in most cases. And I want to go ahead and open the floor up to discussion. What I'm going to share with you today, the fallacy behind technical analysis and the illusion of reducing risk. It's a pretty bold statement. And you're going to be surprised where I take some of the important details today. Some of these insights are going to really rattle your cage, and that's exactly what we want. So I'm going to allow plenty of time at the end of the broadcast to do Q&A. I'll go through the material, try to be as thorough as I can, and then open the floor to questions and answers. And let's see if this is resonating with you guys. So let's go ahead and get right to work. All right, first of all, I don't know who's listening. So let's make sure that the regulators are happy and that if you're a brand new, fresh out of the box minted trader trying to figure out if this is right for you, I want to just offer you a disclaimer here. It's very important. You should really carefully consider if trading is right for you in view of your tolerance for risk, your emotional and financial tolerance. People can and do lose money trading in futures, forex, and options. Um, and there's no guarantees of any kind. So past performance is no guarantee of future results. And also, everything that we talk about in here, really, in the bottom line, you're going to have to consider an opinion. This is my point of view. You may not agree with it. It's subject to change at any time, and there's no representations or guarantees or accuracy of anything in here other than what I tell you I've done my homework on, and you're welcome to double check that and fact check that all you want. So now that the regulators are happy and you've got a chance to think through a few of your issues, let's get right to work. All right, so what are we going to talk about today? All right, I'm going to give you just a one-line answer. We're going to talk about why it is next to impossible to make money consistently from your trading. Most people in here do not know that the reason why you're not doing as well as you could is because of what's happening between your own ears. Most of the reasons why you can't win, or it's almost impossible to win, is inside your head. It's completely psychological. That means your inability to profit is almost exclusively due to how you currently are managing your thinking. How do you manage your thinking? Have you ever given thought to what it means to manage your thoughts? And it also is a big part of what you're putting your confidence into. What is it that you are trusting that you think is going to help you make money? And the thing is, this failure inside your head, this really isn't your fault. Um, and I'll tell you why it's not your fault. I'm guessing this because I don't know you personally, but I'll tell you why I don't think it's your fault. Because you have been told what you've been told by the people who have told it to you. No one has ever really explained to you what's happening inside your trading method, the real issues that you got to deal with. That's never really been discussed with you. And so you're operating in this highly dangerous and easy to lose environment and you're trying to figure out how to make this happen for yourself. Why do you think there's hundreds of people that you could talk to every day about, well, here's how you do this? It's because everybody starts from the same spot. They have no clue what this is all about, and they try to get educated, and they try to learn what's happening, and what they don't know is that where they're going for all of that isn't really going to help. Nobody has really told you that. So basically, here's the real issue, right? Is this. You don't know what you don't know. You don't. So now we're going to talk about that. I'm going to educate you on something that you probably have never given any thought to, and it's going to open your mind up to how to really do this, hopefully. So, your key takeaway from this presentation, here's what I want you to write down and focus on. The battle for the money is in your mind, it's not in the market traded. In fact, the less you know about the market you're trading, the easier it is to win. We'll talk about that some other time. So who is this guy? Let people, I can hear you. I can hear your thoughts right now. Who is this Jason guy? Right? Okay. Well, I'm going to offer you some insight here about me personally, so you can have some confidence in what you're hearing. And I'm going to tell you why you should seriously consider the implications of what I'm going to discuss with you, because this isn't a game. See, you're going to lose your money doing this if you're not smart enough to figure it out. That's going to happen. It's not my opinion. It's going to happen. So how do you prevent that from happening? Because it's not a game. The probability of you winning, I'm going to show you this in just a minute, is really low. How are you going to solve that problem? Well, I had the same problem. Why? Because I started as a customer, just like you. I opened my first account in 1986 as a customer trading in big board corn during the alleged drought, spring 1986. I followed all the same material, same stuff you're using right now. Right now, on your desk are stacks of books. I've read every one of those. Charts, I've done every chart analysis you can think of. I've been through everything that you can possibly think of as a potential trading environment at least a dozen million times. I've followed all the same stuff, right? I had a complete epiphany of understanding that changed everything for me. For those of you that are not familiar with who I am and what I do, I've got several books published, three by Wiley and Sons, one self-published. And in my second book for Wiley, The Art of the Trade, I talk about this epiphany of understanding and what happened to me and why it is so important for you to have the same understanding. What is that epiphany? I'm going to talk about that today. Now, I don't use technical analysis the same way you do. I promise you, if you're using technical analysis right now, the way you're using it is part of why you can't win. And we're going to talk about that today too, right? So what I'm going to do is I'm going to show you the exact same information that changed my whole world and started me on the path to permanent success. And what I'm telling you is this material is heavily vetted. It's highly valuable for the right person. If you're the right person listening, this is going to change your life. Or at least it'll start you down the pathway that you could have your life changed. Hopefully you're going to be everybody listening is that guy. All right, so let's just go ahead and get to work. So I started my journey from loser trader to winning trader with a simple question. Why am I losing so regularly? How come every time I open my account, my chart, my accounts, and start to trade, how come every day I'm losing? Why am I losing so regularly? What am I doing wrong? How many times you ask that yourself? How many times you ask that question? What am I doing wrong? It's a wrong question to ask. We'll get to that too. So here's what I learned. And the fact is, this is not my opinion. The fact is, almost everybody participating is losing. The actual numbers are a staggering 85% or higher of people trading right now. Everybody listening, everybody that's got an account open on the other side of the globe, 85% of all of us are going to lose money from their trading. They're going to close their account at a net loss. Now, that's not opinion. That's data collected from all sides of the business. That's from the regulators, the brokers, the clearing firms where you keep your accounts right now, individual fact checkers, as well as a few others, people doing research on the viability of the markets. 85%. When I discovered this fact, I asked myself another question. What are all these people doing that creates such a high loss level? What is it that they're doing? How can it be this bad? Well, here's the short answer. They were doing the exact same thing I was doing. Me, you, everybody trading, all of us are doing the exact same thing all the time. And that is the real reason why you're losing so consistently. We have, quote, bought into this belief structure where it's inside your head. You have bought into this belief that we can benefit if we study the markets. We can learn the markets. We can gain an advantage by research into all the data that surrounds the markets. We believe those in the business of educating traders are trustworthy and they know what they are doing. We believe the knowledge they share must be valuable, otherwise, so many people wouldn't buy it. We believe that everything we are presented with must be sound. This is all for my benefit. I can study this stuff and figure it out. That's what's going on in your head right now, and that's why you're losing. In short, we are accepting that the way to make money is to educate ourselves about the markets and trading. And we do this education at the deepest level possible that we can find, all the time, while finding the best minds in the industry to help us, right? We do this without question. We do this without looking at our results, just assuming this is the way to do it, right? But nobody is asking the question, what if all this analysis is just bullshit? Did you ask that question when you got up this morning, opened up your copy of your trading books, and asked yourself, what am I going to learn today to reduce my risk? Did you ask the question, what if all this analysis is just crap? See, if you're honest with yourself, you can lie to yourself all you want. It doesn't affect me or my income. But if you're honest with yourself, completely honest, you've never asked that question. You have just followed along with everything you've been told by all the gurus you have been exposed to. You've never questioned the process of educational. What really are they teaching you? And at no point have you ever considered that maybe something somewhere isn't right. So what is technical analysis? What is this we're studying? Well, here's what it is. Technical analysis is the study of market action primarily through the use of charts for the purpose of forecasting future price trends. Now, you know who said that? John Murphy, technical analysis of the financial markets. Anybody out there want to hazard a guess and ask how many people have read this book? How about everyone? You have the big blue book, Technical Analysis of the Financial Markets, 850 pages. Almost everybody here has a copy, I'm sure. Now, pay attention here. This is really important. Technical analysis is the study of market action, primarily through the use of charts for the purpose of forecasting future price trends. In other words, you're supposed to take the data that's on that chart in front of you and study it because that's going to tell you where the market's going next. And you can profit by reducing your risk. All right. That's the theory here. Now, I'm going to show you something that I'm guaranteed you've never heard before. All right. Now, here's why you cannot forecast prices. You can't do it. Here's why. Prices move from order imbalance, not because of anything else. You have to remember the game you're playing in. You're playing in something called a zero-sum transaction. And this is the nature of zero-sum market transactions. You have to have a buy order match against a sell order for a price to print. So one buy order comes in against a sell order, and they're matched. Orders must be matched in order for those orders to be active and for a price to print. In the matching process, there will always be some sort of an imbalance, meaning the orders come into the market and there's an order that the sum total of orders on the buy side is 573, and on the sell side it's 468. So that order flow imbalance of 100 orders, what does the market do? Well, there's more buy orders than there are sell orders. All the orders on the sell and buy side have been matched. There's 100 buy orders left over. The market goes up one tick looking for more sell orders, and it'll keep doing that until it finds more orders from the missing side. That's how the prices move. That's it. Nothing else. Not a single shred of the news, previous prices, fundamentals, technicals, what Mr. Powell is saying on the news, legislation passed or ignored. None of that has anything to do with why the price is moving. The price is moving because more orders on one side than the other, and that's going on all day long. The imbalance drives the price. Nothing else creates price action. So if you personally believe something else about why prices move, there's some other reason involved. You're operating inside an illusion about price action. This illusion is likely a large part of what's creating your losses. Because you believe something about price that isn't true, you're not in a position to know what's really happening. Therefore, the probability of you being on the right side at the right time is lower. So why trusting TA leads to losses? Let's talk about this. First, if you study the market, as John Murphy suggests, then you are expecting your study to show you better places to buy or sell, right? Why else are you doing this study? Because there's a better place to buy or sell than another time, right? You're believing there's a relationship between one previous price or a group of previous prices and the unknown future prices coming next. In other words, you think that by combining and dividing all these prices according to some rule set, that's going to predict where the price is going next. But the only reason the prices are moving is because somebody's willing to put an order into the machine and somebody else isn't. So now we're going to study the market and find a way to reduce the risk of that happening. We don't know where the orders are going to be. So we're going to study the market and find out which group of ordered prices in the past are going to tell us which group of prices is coming next. See, what you're really doing is you're trading your belief structure. You're not trading the market. You're not trading the true nature of the market. You're trading what you think is going on. Therefore, you're guessing. You're actually guessing. And you have next to zero chance that your guessing will be accurate enough to be right about the next round of price action enough to consistently win. Everybody is guessing. They're using all this crap. They're leaning on all this stuff they've been taught and learning on their own in books and charts and ratios. They're doing all this stuff because they think that's going to show them a better place to buy or sell. And in fact, that's a guess. But they don't know it's a guess. This is why about 85% of people are losing all the time. They believe that there is a reason to study the markets. They believe that that study will show them where to buy or sell in order to win. That belief itself is a logical fallacy. That's something called the gambler's fallacy. And most traders are losing because in reality, they're guessing. They're guessing about potential prices coming down the pike. They don't really know. And this is where it gets really interesting. The mathematical fallacy of TA. More importantly than the fact that we're using all this incorrectly is this. Technical analysis has an underlying fundamental error embedded across the board that appears to be completely ignored by people using technical analysis. It's called auto regression. And rather than getting a whole big thing about this, you're welcome to do what I did. Take my theory that I've been working on for decades, and run it through ChatGPT and two or three other artificial intelligence modules and find out exactly what's happening. And when you do, you'll come to the same conclusion. Auto regression is the term used. Basically, here's what it means. It means this mathematical reality is very simple. Here's what it means. You cannot use the same or equivalent variable in any equation designed to predict the future value of the same variable. In other words, you can't use variable A, which is the price, inside any complicated algorithm or equation intending to predict the next or future values of the same variable. In other words, if you got a price and they massage it with all this information and that mathematical stuff, it's supposed to predict the price. Well, that is actually a mathematical fallacy. It's called auto regression. It's an error. It doesn't work. It produces what do they call it? Garbage in, garbage out. It's the same thing. See, basically, every one of that huge number of mathematical calculations employed by tech heads is caught in this fallacy. It's inside every one of them. You are using price, a variable, inside some sort of equation or algorithm designed to predict which price, meaning the same variable, is coming next. You can't use variable A to predict variable A in an equation because all you get is circular reasoning. You're using variable A inside a calculation designed to predict variable A. This is circular reasoning at best, and that's why TA is actually worse than chance. Chance. Should I go long or short today? Flip a coin. You'll have a better chance, a better probability of winning by flipping a coin than you will by using TA because TA is always going to result in a numerical number that is completely erroneous to the actual market every single time. This is the formula for stochastics. I want you to look at this real close. Any of you out there know who stochastics is or what stochastics is? Just for the sake of future reference, you guys get an idea about how serious I was and still am about this business and my background and how heavily vetted what I'm sharing with you is. I'm the only person you'll ever meet that has actually met George Lane. George Lane is the guy that invented stochastics. I found him at his office in the Board of Trade when I started trading in this field in 1987 because I wanted to know what was stochastics. At the time, there were only a handful of technical indicators that you could use. That's because in the 80s, this was still mumbo jumbo hocus pocus. Now it's considered a science, but it's not an accurate science, and we'll get to that in a minute. But this is what I learned from George Lane. You take C, this is the closing price, and you subtract the lowest low from the past 14 days. See N right there, LN, HN, LM right here. All right, what you do is you take the highest high in the last 14 minus the lowest low in the last 14, divide that by the closing price, subtracting the lowest low, multiply that times 100. Do you see where this could create what this does here? Do you guys see what this does? You take the price, add and subtract it, then divide by the price, then multiply the price times 100, and that's supposed to be, that's the place you get in. You see what I'm saying? Can you see the error in that thinking? What is the whole point of this calculation? To predict a price point where buying or selling would be better or less risky, right? Isn't that why it's being done? How will adding, dividing, massaging all the previous prices predict the price level where it's better to enter the market? How's that going to happen? See, your trust in technical analysis leads to the illusion of reducing risk. You can't reduce the risk. Ask yourself, why do traders willingly participate in an environment that involves the risk of loss? Why are you doing this? You know you could lose money, so why are you doing it? Because you can make a lot of money when you're on the right side of the market. Well, I'm not going to disagree with that. Are any of you going to disagree with that? Probably not. So here's the next assumption that almost every trader you make, and I'm sure you've made too, this is what you're going to make next. Well, because you could either lose or win anytime you make a choice to get in, it can't be just that random. There must be a way to reduce that risk of loss somehow. There's got to be a way to reduce that loss, that risk of loss. Well, you can't. It's impossible to reduce the risk of loss because the risk itself is created by only one thing and it will never change. Here's why you can't reduce the risk of loss. The risk of loss comes from only one thing. This can never change, and this is it. You could be on the wrong side of the order flow. Now, you remember when I said prices rise because buy orders and sell orders are matched, and when that's done at a certain price, if there's more buy orders left over, price will rise looking for sell orders to match. So buy orders come in, sell orders come in. If there's an imbalance, which there always is all the time, otherwise prices wouldn't be moving, then wherever the imbalance is, that's where the market goes. But you could be on the wrong side of that. You could think it's time to buy because however you did it, and when you put that buy order in, it's matched against somebody else's sell order, but there's more sell orders left over than there are buy orders, so the market goes down looking for more bids underneath the market. You're now holding an open trade loss. So you cannot reduce this risk no matter how much illusory study of the markets you do, because it is impossible to know if someone will place an order. There's 500,000 people every minute in the dollar yen all over the world. How many of them do you know personally? When are they going to enter their orders? You don't know that. You don't know when they're going to place that order, and therefore it's going to add or subtract to the existing order imbalance. You don't know that until they actually place the order. So when is that? You get to find out about that later. That's called volume, and you can't know volume until later. So let me summarize. By taking each of these pieces individually, you should be able to see that there are several fundamental flaws in this alleged science of technical analysis and what it is supposed to do for the person using it. Part of the problem is how we as traders put our confidence in TA. We think this makes a difference or this can help, and it can't. There's a very basic problem in the calculation of why one price is better than another to sell at or buy at. And that order is the auto regression problem. That's the name of it. The other thing is we put our confidence in this thinking that TA is going to give us a way to get in a better place, so that means we're reducing the risk. But you can't reduce the risk because the risk is always the same. The same risk applies every second of every day. I could be on the wrong side of the order flow. If I'm on the wrong side of the order flow, I lose. So now you're operating inside this illusion, which is causing you to guess at what point is better to buy or sell, and you're losing almost all the time. See, drawing lines, using ratios, placing dots, curvy lines in certain places, combining, dividing various sets of price numbers on an open, high, low, close price chart with the intention of gaining clairvoyance over which set of price numbers are coming next. All of this is an actual logical fallacy for a number of reasons. First, using the price, variable A, in any calculation intended to predict the next price, variable A, is an outright mathematical contradiction. It's a fabrication. It will never lead to a viable outcome. It is circular reasoning. Next, because prices cannot move without orders being placed, attempting to predict prices without an understanding of how many orders are coming into the market next is a logical fallacy called the gambler's fallacy. This is the error that says I want you to really understand this, two completely unrelated activities will affect the other. That's the gambler's fallacy, right? What does that mean? This is no different than rubbing a rabbit's foot before rolling dice, expecting a certain number to result. Or wearing your lucky tie when trading. There's no relationship between rubbing a rabbit's foot and rolling the dice looking for a hard four. No relationship at all, period. But you think there is, and that's called gambler's fallacy. There's no relationship between technical analysis and the next round of prices coming next, but you think there is. So therefore, you're guessing. So last, using all the various kinds of available TA is done for the purpose or the intention of predicting price. That's what John Murphy taught us. He taught us the whole purpose of this is to price predict, forecast the next round of prices. It's all done in the emotional hope of reducing risk. But the risk to the trader cannot be reduced. There's only one risk. You could be on the wrong side of the order flow. That's it. That will result in price activity going against your executed position. Everybody runs that risk. There is no way to reduce that risk because you don't know who's going to place an order next and you don't know how big they're going to be. So you can't predict price. You can't forecast it. Nobody can. It's impossible to know in advance what the order flow will be until after traders place their orders. That's why we study volume. That can only be known after prices move. So, for example, this is it in a nutshell. If you decide to go long, your risk will always be the same. It will never change. I don't care how. I've been trading for next spring 40 years. I've been trading longer than a lot of my students and customers have been alive. I still have losing trades because I don't know where the order flow is any more than you do. Nobody does. So this is the risk. If there are more sell orders coming, you lose. If we put a long on and there's more sell orders coming, you lose. You cannot study your way out of that risk. It's not possible. So here's the conclusion I want you to chew on. This is very important, and we'll open the floor right now to questions. Using or expecting technical analysis to help you find, quote, better trades and or, quote, reduce the risk of trading, that's really just an illusion. The fact is, roughly 85% of people trading in futures, options, Forex right now, they're going to close their accounts at a net loss. And the common theme behind all of them is this eternal and unexamined belief that they can reduce risk and make money by the exhaustive study of the markets while using TA to assist gurus who offer education or trading methods that are intended to, quote, reduce risk once you understand those methods or you understand them. How are you going to beat those odds doing the exact same thing everyone else is doing and using the exact same tools to do it? So, thanks for listening. It's been a pleasure to share these insights with you. I hope they resonated with you. As I mentioned at the start of the broadcast, this is the exact same information and thinking process that led me to my epiphany of understanding. This is what changed my life. I went from being a losing trader to winning trader almost overnight. I haven't had a losing, I can't remember the last time I had a losing year. I do have losing weeks and losing months. Yes, I'm not perfect. Nobody is. But I know how this business works now, and I know why putting my confidence in technical analysis and all that kind of stuff was a waste of time and will never make me any money. I now know how to use all that stuff. See, the difference between what I do and what you think I do is this. I know what you're thinking because I used to think exactly like that. And I know what you put on your charts, and I know what your charts look like. And I have those charts. They're called loser charts. I'm not saying you're a loser specifically. I'm saying that people who trust this stuff the way it's told to them to trust it end up losing more than winning. So I know where you're placing your orders. I'll give you an example of how I know that. Every now and then, I'll take time and go study what's out there just to stay fresh on it. And some of you people probably heard of the Online Trading Academy. Well, the Online Trading Academy, I went to one of their weekend things and got the big, input on one of their methods that they teach their customers. And I asked the guy that was trading or teaching the course, I asked him, I said, how many people have you taught this to? He says, well, we've been around almost 20 years now. At the time, that's what he told me. He says, and we've taught almost 250,000 people how to profit. Oh, so you've taught 250,000 people all the same thing. So anytime this pattern shows up in the business, there's 250,000 people going to sell it. Well, I know, then that means I should be buying it because they're not going to win because they're doing it all wrong. That's the difference. See, I use technical analysis and all this study and stuff that I'm trying to help you understand doesn't work. I use that not to find myself a trade or to reduce the risk of a trade I'd like to make. I use all of it to find you. I use it to find the loser. I want to find the guy who's going to lose today. I want to find that guy. When I find that guy, I take the opposite side of his trade. I don't care what the market is. I don't care what the news is. I don't care tomorrow. Non-farm payrolls are coming out at 8:30 Eastern, and I bet every one of you has got an idea about what that means. And I'm telling you, it doesn't matter what it means because whatever you do, I'm going to do the opposite, and I have an 85% chance of winning on that trade. Do you understand what I'm getting at? That's the difference. How are you going to beat those odds if you do the exact same thing everybody else is doing all the time? You can't. Using the same tools that they're using. This is the difference between understanding what the crowd does and what the winners do. So, for those traders who would like to explore this kind of content more deeply, I got some free stuff for you. Here's my podcast. You can go to this podcast right here. You can go to my website, netwinningtrader.com. Just sign up and start listening. So the floor is open for Q&A if you'd like to go ahead and ask some questions. And here's how you can stay in touch with me. Feel free. Support at netwinningtrader.com. And happy to help you if I can. And guys, if you can kind of sense that my point of view is maybe a little different, a little radical, and not really the kind of thing you were maybe expecting, that's good because that's designed to help you think, to get out from under this problematic method of thought that you have right now, thinking that you're going to study your way into making $1 million, and it's not going to happen. Not for you, not for anyone. So if you want to win, you want to learn how to win, you got to take a different point of view in the marketplace. You need a change. Your paradigm needs to shift. You need a paradigm shift is to understanding how the money is really made. What we've talked about in here today is just the tip of the iceberg of what you need to really begin the process of change. But I want you to really remember this. Technical analysis is mathematically flawed. It uses every single one of those indicators that you could look at, all of them, use some form of massaging price. They take the price and add or divide and massage it and put some algorithm on it, and it comes up with another number. And that number, which is also the price, is supposed to be the place where you can win now. And that's a logical and mathematical erroneous fallacy. It's a failure. It will not work. And if you continue to use that stuff and trust it, you'll end up with net losses more likely. On the other hand, if you stop right now and turn around and go the other way, there's a pathway of education and training that might make a difference for you if you're willing to adopt it. So let's see if the floor is open here. I said it is open. Let's see if we have any comments or questions here. Let's see. Let's see if I have this right. BJ Shaw wants to know, where do you put your stop loss orders? Well, the simple answer is I want to put my stops in a place where the market can't get to it, because in order to get to it, the order flow would have to change. In other words, if the order flow is net bid, I'm buying, trying to buy. My sell stop, in case I'm wrong, has to be at a place where that market price action would cause all the bulls to quit, enter their sell order, generating an order flow imbalance on the sell side. So what price level is that? Well, this is a much bigger conversation than I can have in the 2 minutes it'll take to answer the question. But it's going to be in a place where the market would convince the buyer he was right. He would add to his long there. He would draw in bigger buyers. Under there is where we want to stop. Typically, what I've discovered is that is a price point that's it's out of range for the past 72 hours of trade or so. So if I'm looking to be a buyer on Thursday, I would put my stop somewhere under Monday's low, if that makes sense. Yes, thanks, he says. Good. John E. says, so you're teaching us how to unlearn what we have learned. Well, I'm suggesting to you that what you have learned is killing you, and all your money's going to go away. Now, if you don't believe that, that's up to you. So I'm not teaching you anything. I'm just saying, if you're not happy with your results and you're tired of spending 50 hours a week scratching your head and reading charts, doing all the same stuff everybody else is supposed to do, and it's not working for you, if you're at that point, there's a reason why you are at that point. It's because the light's beginning to go on for you. There's hope for you. But I had to teach myself all. And there was no, listen, when I got started in this business, there wasn't anything. There was no internet. There was no email. There was no online trading courses. There was nothing. If I wanted to learn how this business worked, I had to go find someone and have them teach me what they knew. I had to either knock on someone's door, ask the right questions, read the right books. There was no, what you can get for free over the internet cost me tens of thousands of dollars when I was getting into this field. All of it doesn't work. So what does work? Well, find the loser and take his money. What does that mean? That means when he's buying, you got to sell. When he's selling, you got to buy. How do you figure that out? Well, that process for me is what took me my whole life. I'm still learning how to do that. But you don't have to be that good at it, honestly, the truth be known, because everybody else is so bad at what they do. You just got to be able to throw the ball out to the ball. You don't have to hit the home run. You just got to be sitting in the stand somewhere and you're in the game. You know what I mean? But unlearning what you've already learned, I would say unlearn it. I'd say forget it all completely and start over. I actually had a student that did that once. He literally took everything he had learned and threw it all out and started over with one sheet of paper and started asking questions. And that guy made phenomenal progress. Very short period of time. And he was a pit trader. Because they got free money. Pit traders, for those of you that aren't really aware of what pit traders used to do, being in the pit was like one of the easiest things to do at the time. Now it's next to impossible because there are no pits. And what used to win in the pits isn't available anymore. So you have to learn this. Otherwise, you'll repeat the same mistakes. What I'm trying to tell you, John, is that what you've been taught isn't working. And there's a reason for that. So how long do you want to bang your head against the wall? That's, I think you guys can see my email address on here. That email address, feel free to put your comments or questions in there. I will respond to everyone, even the people that say I'm out of my mind. I'll give you more of the details that I have to share with you if you want. Um, BJ Sean wants to know, do you go into the psychology of taking a loss? Well, the psychology of taking a loss, let's talk about that. When you say the psychology of taking a loss, can you clarify what you mean? When you say the psychology of taking a loss, what is it that is happening in your mind? What is it you think you're feeling, or you're feeling, or you're experiencing, or can you describe what it means? This is what I think, type of thing. Can you share that with the rest of the group? I have a problem taking stops out, don't want to take a loss. Okay. Nobody wants to take a loss. You're not going to make 100% winning trades. Part of the problem is because your fear of losing is causing you to say, I don't want to take a loss, you're going overboard on the study part to try to find the place where I don't have to take a loss. I got to be in, so now this will work. And you're taking that mindset on every single trade. And you're never going to be a 100% winning trader because that probability of that happening is zero because you can't know what everybody else is going to do well enough so that you can get positioned ahead of their order flow when it changes. No one can do that. So it's unrealistic for you to think you're going to have 100% winning trades. Now, you might agree, yeah, I don't think I'm going to have 100% winning trades, but you're behaving and acting as if you do believe that. That's the problem. That's what it means to say you don't know what you don't know. You're behaving in a manner that says, I don't want to take a loss. I can have 100% winning trades. Therefore, I don't have to place stops. Right? Well, that's not how it works. Some of the most successful people in this field rarely have more than 54% winning trades. Rarely. You can make a very healthy living with a 42% win rate if you know how to hold your winners and cut your losses. That's called the probability of ruin matrix, which is another thing no one's ever taught you about, which I go into critical detail in my material because the probability of ruin matrix basically says this. Look, there's two things going on here when you trade. There's the number of winners you have, and there's a relationship between the wins and the losses. In order for you to make sure you're winning consistently, whatever the ratio of wins to losses is, will then create a need for a certain ratio between the winning trades and the losing trades value. So if you got 42% winning trades to losing trades, you need to take out $2.50 for every dollar you give back. That means if you risk $500 on a trade, every one of your winners needs to be 250% of that, which is how much? $1,750. So if you lose $500 per trade, you better be getting close to $1,700 on your winners as an average. Now, if you can improve your ratio, so you got 55% winners, you can get away with about a two times number. So if you risk 500, you need to make about 1,200, a grand, maybe a little more. Two times the number, right? If you're good enough. So you need to know that relationship. So in order for you to know what your methodology, your ability to find winning trades, your method, you have to know what the probabilities are and how that fits. So your whole thing might boil down to, look, I'm really good at picking winners. I just don't hold them long enough. Or I have a good ratio of winning trades to losing trades. I hold my winners, but I also hold my losers. Well, you need to work on getting out of your losses and just deal with it. You see what I'm getting at? Nobody wants to take a loss, but you have to. Like I said, you can be really good at making yourself a ton of dough, but if you give it all back on one trade, I mean, all of those are psychological issues that happen because no one's ever told you what the real issues are in trading. The real issues in trading are to do what? Get on the right side of the order flow. Forget everything else. You just got to get on the right side of the order flow. When you're on the right side of the order flow, what do? Sit on your hands. If you're not on the right side of the order flow, what do? Get out. Wash, rinse, repeat. That whole process is behavior. So your psychology needs to reflect proper behavior. As long as your behavior is proper, it doesn't matter. You see what I'm getting at? Is the light going on? I hope it is. Yes, this was eye-opening. Good. You're welcome. I'm glad I could be of help. Listen, I know what it's like. Guys, listen to me. If you have, has anybody out there read The Art of the Trade? Anybody listening read The Art of the Trade? Or any of my other books, maybe for that matter? One of the things I talk about in there is the unmitigated emotional and psychological pain I went through because of my losses. And when the light went on for me, and I couldn't sleep for 3 days. When it was an issue of I have to learn how to get on the right side of the order flow. What does that mean? Wait a minute. If 85% of all these people are losing, all I got to do is find the loser and take the other side. And I did an experiment with this. I went to I don't know if you guys have ever been to the Chicago Mercantile Exchange when it had live pit trading, but you could go to the observation lounge and just look out over the pits, right? And I spent one day doing that. And I'll never forget, it was in the meat market, the live cattle market. I went to the observation lounge in the morning, and I had in my hand the open, high, low, close from the day before. I watched the open, and I knew the um, cattle on feed report was coming out that day. I forget what time, but then standing there, and the news was due to come out. And you started to hear the phones ring, and then you saw all these pieces of paper going into the pit, and then just before the news came out, you could see all the pit traders buying and selling. And for the most part, they were buying, right? Buying, 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 buying. All these phones and everything were ringing. The news comes out, the market shot up, and then the very same people that were buying before the news came out started selling. And on a bullish piece of news, the market closed lower on the day 4 hours later. How could it go down on bullish news? Well, the reason it went down is because the professionals were using the market properly. They knew that the average guy is going to look at a piece of news, say it's bullish, and buy. They're going to sell against him. So to get that steam engine rolling, they were buying ahead of the news. Then when the news came, so that's creating the push higher that causes the guy to get in that doesn't know what he's doing. The market's rallying. Bullish news. I got to get in. He buys as the market reaches the end of those buy orders and it's at some high print for the day. The guy that started that whole mess sells into it and liquidates. I'm sure if you went short. That's the whole point. You know what I mean? It took when I learned how I'm like, why isn't this taught in school? Why is it that everybody teaches? Do you know what I use my copy? Well, I don't have it anymore, as a matter of fact. You know what I used to use my copy of John Murphy's Technical Analysis of Financial Markets. You know what I used that I used to use it for? I When I came to this epiphany of understanding, I used to use that book to hold the door open uh, to my screen door in my backyard. You know, so I can get the fresh air to come in. That's what I use. That's what it was worth to me. So what it should be worth to you too. He says, "Where do we get your books?" If you subscribe to my website, if you go to netwinningtrader.com, look at your options for subscription. If you become a lifetime member, all of my books are included. It's part of the library. I've got 40 years of data in there. I add to it every month. Somebody who has a lifetime subscription to Net Winning Trader will probably need several months to go through all the material that's on inside that site. All four of my books are in there. So you're welcome to have a look. Or you can go on Amazon and search the titles and just buy them from Amazon. Zach Jones says the technical trend is your friend until the friendship is over. Okay, that's cute. David just put in Amazon.com stores my name as an author, and it shows you where to go. So thank you, David. We have another minute or two left. It's I get 1:53 by my clock, so I can answer one or two more quick questions if you guys want to take the time. And again, listen, just in case somebody has the wrong idea here, uh, I really do respect what you're trying to do. You're trying to figure this out so you can make money for those things that are important. You know, maybe you promised your wife, a trip to Europe for a month next year. You got to pay for it. You know, maybe you got a kid that wants to go to college. Maybe you're trying to get out of debt or pay off your mortgage or change careers. I understand what you're trying to do, and it's all good stuff. But if you were heading down the wrong path, you'd want to know. I'm here to tell you that I know that. And my hope is that what I shared with you resonates with you so you can begin to see maybe I'm putting a lot of time and effort into places that's not going to come back to me. There's a better way. So I respect what you're trying to do. I don't want you to think that I'm all down on my listeners. I'm not. Carlos 19 says, do you use order flow tools? Well, the fact of the matter is they're really no better than the regular tools. They're a little bit better thought out, but I really don't need to do that anymore because I've trained my mind to think a certain way so well that I can look. You know how you can, if let's say you're a brain surgeon and you can look at a CAT scan and I can you could put three different CAT scans in front of me and I couldn't tell the difference. You put the same CAT scans in front of a brain surgeon who knows what he's doing, and he can say this. Okay, this person is suffering from schizophrenia, this person has dementia, Alzheimer's, and this person is normal. You and I would look at those three scans and say, I have no idea what he's talking about, right? That's how it is with me in the charts now. I can look at a chart and say that market's confused and will likely sell off. That market is confident. That trend still got some room to go just by looking at it. I don't need any indicators, or it's just open, high, low, close is enough because I know what to look for and I can show you how to do that. But my point is using another tool based on the same mathematical fallacy would be a step backwards. So I'm not going to do that. John E says I had to step away. Is there a program offering or are you doing one-on-one mentorship? The answer to that's yes, everything. Just go to the website, look around. Consider me a friend in the business. You can email me anytime and say, hey, I'd like to know more what you do. Great. I'll open the door with you. What would you recommend to follow the order flow? Jeff wants to know. Well, I wish I had time out of time. Uh, I wish I had time. I could do a quick chart study to show you. You know what I mean? But uh, I got 1 minute left. I can't do it in 1 minute. Okay, you have to think of it this way. The best way to understand how the order flow develops is by asking questions. What is changing? What is staying the same? If I was winning, where would I want to get out? If I was losing, where would I want to get out? What price action has to convince me that I'm going to get hurt? What price action is going to convince me I have a chance at winning? Because all that price action is orders going back and forth. So, what is it that's happening inside the marketplace that gives answers to those questions? You see what I'm saying? If I could do, you know, an order flow analysis for you, I would. I'm sorry I can't. I don't have enough time. Maybe we could do that again. Maybe we could make another broadcast. Hey, if anybody wants to do that, just email me and I'll make a Zoom call and I'll just show it to you. Take 15 minutes tomorrow or next week sometime. I don't care. It's easy enough to do. Um, I see that on the charts. Yes. He says, you see that on the chart? Yes. Because you got to know what you're looking at. A chart is not, it's not prices. It's a pictorial representation of people's belief structures. It's what people had, prices are what they are because people had to believe a certain thing. So what do they believe? What is it that they're putting their confidence in? Why are they doing that? See, it's the nature of the questions that you ask that can determine the future of your results. And it's the same stuff you're looking at, same charts you're looking at too. All right, I'm looking at the clock here. I know David's going to jump in any second here to give the next speaker a chance. Are we good to go, David? Do you need anything more from me, or